Are you tired of missing out on the next big investment opportunity? What if I told you their SA stock, trading around $10, that could potentially transform your portfolio? Today we're diving deep into SoFi Technologies, ticker symbol SOFI, financial technology powerhouse that's revolutionizing how millennials and Gen Z manage their money. Whether you're a seasoned investor or just starting out, this video will give you everything you need to know about why SoFi might be the hidden gem you've been searching for. So stick around until the end, because we'll be breaking down the numbers, the growth potential, and whether this stock deserves a spot in your portfolio right now. Let's start with the basics. SoFi Technologies isn't just another bank or another fintech app trying to compete in a crowded market. Founded in 2011 by Stanford Business School students, SoFi started as a student loan refinancing company, but it has evolved into something much bigger. Today, SoFi is a one-stop financial services platform offering everything from student and personal loans to investing, banking, credit cards, and even cryptocurrency trading. Think of it as the Swiss Army knife of personal finance, all wrapped up in a sleek, user-friendly mobile app that appeals to younger generations who want to manage their entire financial life from their smartphone. What makes SoFi truly unique is its business model. Unlike traditional banks that rely heavily on physical branches and outdated technology, SoFi operates entirely digital. This means lower overhead costs, which they can pass on to customers in the form of better rates and fewer fees. They've built a complete ecosystem where a customer might start by refinancing their student loans, then open a checking account, start investing in stocks, apply for a mortgage, and get insurance, all without ever leaving the SoFi platform. This creates what's called a sticky customer base, meaning once people start using SoFi for one product, they're likely to use it for multiple products, which dramatically increases the lifetime value of each customer. Now let's talk numbers, because that's what really matters to investors. SoFi has been growing at an impressive rate. Their member base has been expanding rapidly, crossing over 7 million members. They're adding hundreds of thousands of new members every quarter. But here's where it gets interesting. SoFi doesn't just count total members, they track what they call products, which means the total number of financial products their members use. As of recent quarters, they've surpassed over 10 million products, and this number keeps climbing. Why does this matter? Because the more products each member uses, the more revenue SoFi generates per customer, and the more likely that customer is to stick around for the long term. Revenue growth has been equally impressive. SoFi has been consistently beating analyst expectations quarter after quarter. With revenue growing at double-digit percentage rates year over year, they've diversified their revenue streams across three main segments: lending, which includes student loans, personal loans, and home loans; financial services, which includes their banking products and SoFi Money accounts; and technology platform, where they provide white-label banking technology to other financial institutions through their Galileo and Technisys acquisitions. This diversification is crucial because it means SoFi isn't overly dependent on any single product or market condition. One of the most exciting developments for SoFi was obtaining a national bank charter in early 2022. This was a game changer for several reasons. First, it allows SoFi to hold deposits directly rather than partnering with other banks, which significantly improves their profit margins on lending products. Second, it gives them access to cheaper funding for their loans, making them more competitive. Third, it positions them to offer FDIC-insured accounts, which builds trust with customers who might be hesitant about keeping their money with a purely digital platform. This bank charter essentially leveled the playing field with traditional banks while maintaining all the advantages of being a tech-forward digital platform. Let's address profitability, because this is where some investors get concerned. It's like many growth-focused tech companies, SoFi has been investing heavily in growth, marketing, and technology infrastructure, which means they've operated at a loss or break-even for several quarters. However, the trajectory is important here. They've been moving steadily toward consistent profitability, with improving margins each quarter. They've achieved GAAP profitability in recent quarters, which is a significant milestone. The company has demonstrated that their business model can be profitable while still investing in growth. And as they scale, those profit margins should continue to expand because their fixed costs get spread across a larger customer base. The competitive landscape is something we need to discuss honestly. SoFi isn't operating in a vacuum. They're competing against traditional banks, other fintech companies like Chime, Dave, and Robinhood, and even tech giants like Apple, who are moving into financial services. However, SoFi has several competitive advantages. Their integrated platform approach means they can cross-sell products more effectively than single-product competitors. Their strong brand resonates with younger consumers who distrust traditional banks. Their technology, infrastructure, especially after acquiring Galileo and Technesis, gives them capabilities that most competitors don't have. And their focus on higher-income millennials and professionals means they're targeting customers with significant lifetime value potential. Now let's talk about risks, because every investment has them, and you need to understand both sides. First, there's regulatory risk. As a bank, SoFi is subject to extensive regulation, and changes in banking regulations could impact their business model. Second, there's interest rate risk. Rising interest rates can impact their lending business both positively and negatively, affecting demand for loans and refinancing. Third, there's execution risk. SoFi's growth strategy requires them to successfully integrate acquisitions, launch new products, and scale their platform without major hiccups. Fourth, there's competition risk. The fintech space is incredibly competitive, and new entrants or aggressive moves by established players could pressure SoFi's market share and margins. Finally, there's market sentiment risk. Growth stocks like SoFi can be volatile and sensitive to broader market conditions, especially when interest rates rise and investors rotate from growth to value stocks. The valuation question is crucial for any potential investor. At around $10 per share, is SoFi a bargain or appropriately priced? Compared to its highs of over $20 in the past couple of years, the current price represents a significant discount. However, we need to look at fundamentals, not just price history. Analysts have mixed opinions, with price targets ranging from single digits to mid-teens, depending on their assumptions about growth rates and profitability timelines. What's important is understanding that SoFi is still in growth mode, so traditional valuation metrics like price-to-earnings ratios might not tell the whole story. Instead, investors should focus on metrics like revenue growth, member growth, product adoption rates, and the pathway to sustained profitability. Looking at the broader trends that could benefit SoFi, we see several tailwinds. The shift from traditional banking to digital banking is accelerating, especially among younger demographics. Student loan refinancing remains a massive market, and as federal student loan policies evolve, there will be continued demand for refinancing options. The gig economy and remote work are creating new financial needs that traditional banks are unwell positioned to serve. Cryptocurrency and alternative investments are becoming mainstream, and SoFi's platform supports these products. Perhaps most importantly, younger generations are accumulating wealth and entering their prime earning years, creating a growing addressable market for SoFi's premium financial services. The management team is another factor worth considering. CEO Anthony Noto, who previously served as CEO of Twitter and worked at Goldman Sachs, brings both Wall Street credibility and Silicon Valley innovation mindset to the company. The leadership team has consistently executed on their strategic vision, hitting their guidance targets and milestones. They've been transparent with investors about challenges and opportunities, and they've demonstrated discipline in capital allocation, focusing on profitable growth rather than growth at any cost. Strong leadership matters tremendously in the fast-moving fintech space, where strategic decisions make or break a company. So should you buy SoFi stock right now? Here's my take, keeping in mind that I'm not a financial advisor and this isn't personalized investment advice. SoFi represents a compelling opportunity for investors with a medium to long-term time horizon who believe in the digital transformation of financial services. The company has proven execution, a differentiated business model, strong growth metrics, and a clear path to sustained profitability. At current prices around $10, the risk-reward ratio looks attractive for patient investors. However, this isn't a risk-free investment or a get-rich-quick opportunity. You need to be comfortable with volatility and the possibility that the stock could move significantly in either direction based on quarterly results, market sentiment, or broader economic conditions. If you're considering investing in SoFi, here are some things to watch. Pay attention to their quarterly earnings reports, specifically looking at member growth, product adoption rates, revenue growth, and progress toward profitability. Watch their net interest margin, which indicates how profitable their lending business is. Monitor their customer acquisition costs compared to lifetime value, which tells you if their marketing spend is efficient. Keep an eye on their technology platform segment, because this could become a major growth driver if they successfully sell their infrastructure to other banks and fintechs. And stay informed about regulatory changes that could impact digital banks and fintech companies. For those who decide to invest, consider your position sizing carefully. SoFi should probably be viewed as a growth position in a diversified portfolio rather than a core holding, at least until they demonstrate more consistent profitability and less volatility. Dollar cost averaging, where you buy shares gradually over time rather than all at once, can be a smart approach for a stock like this that can experience significant price swings. And most importantly, only invest money you can afford to have tied up for several years. Because the real value creation with a company like SoFi will likely unfold over the next 3 to 5 years, not the next 3 to 5 months. In conclusion, SoFi Technologies represents one of the most interesting stories in the fintech space right now. They've built a comprehensive financial services platform that appeals to a growing demographic. They're executing well on their growth strategy. They've achieved bank status, which strengthens their competitive position, and they're trading at what many analysts consider an attractive valuation. Yes, there are risks, and yes, the stock will likely remain volatile. But for investors who do their homework, understand the risks, believe in the long-term shift toward digital financial services. SoFi at around $10 per share deserves serious consideration. Remember to always do your own research. Consider your personal financial situation and risk tolerance. And never invest based solely on what you see in a YouTube video. If you found this analysis helpful, please hit that like button, subscribe to the channel for more stock analysis and investment ideas, and drop a comment below letting me know what stock you'd like me to cover next. Until next time, invest wisely and stay informed.